guys and girls, welcome to a macro minute. So today I'm going to be looking at bonds. We're going to start really basic and then work our way up. So for those who have looked into the bonds already, you might know what we're going to speak about today. But for those who don't know, we're just going to go through a little slide PowerPoint. It's not too long, should be fairly quick, hence macro minutes. My way of teaching tends to be kind of like this, whereby we go on a kind of zoom and then we go on to examples and charts, etc., which we'll get onto in another video. Today we're just going to get the absolute nailed basics, and then we'll go from there, of course. So let's have a look at the PowerPoint. So what are bonds? So get rid of my face. So what are bonds? So we're going to just have a look at absolute basics as usual, and then the next couple of videos we're going to look at a bit more advanced, and then we're going to look at how to apply this onto FX and etc. For those who trades equities, you can have an indirect. It's kind of opposite of how it affects FX, whereby if we understand that as the yields move up and rates move up as well, it tends to affect negatively on the equity market. But that we'll apply it more to FX, as 95% of us are FX traders. So what are bonds? To put it most simply, is when investors lend money to companies or governments for a set time/period in return for an interest on their capital. So think of it kind of like a coupon, or where you're pretty much you're getting an almost guaranteed return on your investment. It's a good tool for creating cash. So if a company or a government, for example, they need money to either fix up their economy in the market has undervalued the FX spot price. Of course, higher the yield also adds on to credit spread. So the higher the yield on a bond, we'll use the government issued bonds. So we'll use for example, the let me just get up the Greek bond at the moment, and then we'll tell you, of what I mean. So let me just get up the Greek 10-year bonds. So if we look at the Greek 10-year bond yield, that's currently trading in at around 2.92%. So on a primary note, or on face value, it kind of tells us that the markets are pricing in hawkish, potentially hawkish Greek central bank. Of course, that will it is within the Eurozone, so it's more to do with the ECB. But you also have to know that the higher the yield on a bond, especially government issued bonds, the more likely it is to default, i.e. to not be able to pay back the bond or the money that you owe. And it's kind of like when you default on a loan, or you basically claim bankruptcy. It's kind of like that, whereby they say they cannot pay it. They have to, write off on the books and default on that. And of course, that comes in on the risk of that premium, i.e., if the yields in the Greek 10 years are at 12%, that's a high chance that the government is going to default on their bond and not being able to pay back the investors. So that's something you just do have to note for in the future as well, for those who are looking to go into a bit more depth. So bonds, you may see some terms such as yield to maturity, coupon rate, default, which I've just spoken about, and principal, but don't worry, you'll understand this during this presentation. So yield to maturity, this is how much rate of return the investors is expected to make by the end of its maturity of the bond. This reflects all the interest rate payments from the date, or interest payments from the date it was purchased till the maturity, which includes the interest earned on the interest. So by the end of its maturity, basically means, by when it ends. And a high yield to maturity can be a good thing, but it depends on the current fundamentals from the company or country is issuing the bond. So that is something to note there, because, the higher the yield to maturity, it does have its positives and it does have its negatives, of course. We do have to just be very careful when looking into this, more to do with the fact that, traders and investors more look at the coupon rate, which we'll get onto in a second. Traders at banks, etc., look at the yield to maturity a little bit more than the coupon rate. So, it's interesting to note that, the higher the coupon, or if the yield to maturity is obviously higher than the coupon rate, it kind of suggests that the market or the bond, shall we say, is being sold at discount to its par value. So the par value is what it's priced at the moment, $100 to get into the bond, for example. If of course the yield to maturity is lower than the coupon rate, then the bond is being sold at a premium. So we just have to, of course, just keep eyes out for that as well. And you know, it is important to know. But so what you have to understand is the question is whether or not the discount is justified, of course, by the fundamentals, such as the credit worthiness of the company issuing or the country, or the interest rates presented by alternatives or investments, as is often the case in investing. Further due diligence would be required. So it's important just to note that, of course, you know, the higher the yield to maturity, it could obviously indicate a bargain opportunity, but then it comes at a point where, you know, it might not be a good thing for the bond traders to get into. You know, the credit worthiness of the company, i.e. if it's AAA, you know, or it's an A class bond, you know, it's likely it's a very, very high quality. Or if it's trash and junk bonds, C's and B's, you know, that's more likely default, but you also are more likely you can make more money on it. So it's kind of a proxy. It's completely up to the risk of the investor who wants to invest into it. But for us as FX traders, you don't really need to know too much about yield to maturity, but it's just something there just to memorize. Coupon rate. So this is of course going to be more for us. This is known as the annual income that the investor is expected to have whilst holding the bond. This is a fixed sum of agreed in their contract. I've spelled some wrong, sorry about that. Coupon rate can also be referred to as the yield. So of course, you know, the US 10-year yield, it's two-year yield, etc. Typically, investor will look more at the coupon rate, and the yield to, as I said at the start, yield to maturity is typically used by bond traders at banks, etc. For example, US 10-year government bond yield is at 2.06%. This means the investor will take home 2.6. This as an example, for example, will take 2.60% each year for the next 10 years. It may not seem like a lot, but as they're investing way more than we can imagine, it adds up. It could also be seen as a way of reducing inflation effects on money. Meaning, you know, if you put your money, interest rates at 8%, for example, and, you know, the bond is paying you out 2.06% a year. So now you're only going to be down about 5.94% of your money away. So there's of course positives to that. It can be used as an inflation hedge in that sense. So that's just something to note there. You know, as FX traders, etc., we do have to be looking more at the government issued bond yields rather than, you know, companies, etc. So if you do want to invest into companies, of course, you can look into that a bit more. Defaults are when the bond issuer cannot make its payments to its bondholders, similar to when everyday people can't make payments for their credit cards. Exactly how I said at the start, they're not able to pay back the money that they owe, and they have to have a default on that. So that's just something to note. As I said, you know, higher the yield on the bond, the more likely it is to default. You know, the credit worthiness then comes into play. How is it AAA? Is it triple B, triple C? Is it junk? We understand that Greek bonds are junk, meaning although it can make yourself a lot of money, it's a lot more likely to default on that. And the principal. So this is known as the original sum of money that the investor puts into an investment or bond. This can also be referred to as the face value. For example, the investor buys a US 10-year at 2% and pays $100 for the bond, for example. This will be known as the principal. This will get paid to the investors once they are happy, plus the interest paid on the bond. So as I said, you borrow, you know, $100 or even $10,000, you give that to a company or a government, then they have to pay you back the principal once you jump out of the bond or once it matures. That is the end. So we just wanted to start super basic, just super basic. But just to summarize, you know, we have to be looking more towards the coupon rate on the bond, you know, the government issued especially, because as I said at the start, let's go back to the start, It can be used for gauging monetary policy and market pricing. Of course, that all depends on what the fundamentals within the economy is at that time. You know, are they going for a huge amounts of unease, wars, for example, maybe even, you know, for example, the French elections that we are currently experiencing? Are they going through a lot of issues? And is there going to be a point of you know, becoming super bullish on a currency during that stage? Although the yields might be moving higher, it's going to be pushed down, or the pressure is going to be pushed down on top of the currency because of this issue with the presidency, etc. So it's just all dependent on fundamentals. But if all green and all go full steam ahead, then it's a very, very good tool to add to your arsenal. Okay, so just something to note and something please look into, because it will take your game to that next level, I promise you. So that is it on the absolute basics. I want to start off nice and easy. Don't want to go super, super complicated. And the next couple of videos, we're just going to be looking at how to apply this into FX and just stuff to think about. So that's it on the basics of bonds. See you in the next one.